On behalf of Crosscheck Media and Biz Talk Today TV, welcome everyone to Hatfield Economics. I'm your host, Todd Schoenberger. Joining me as he does every week is Jay Hatfield. He is the CEO of Infrastructure Capital Management as well as the CIO of ICAP ETFs. Jay, we have breaking news right now. We have a stock market all over the place. Very, very volatile. Violent volatilities taking place right now on Wall Street. Can you tell the audience about the rumor that you just heard recently?
Yes, so I think we've all grown extraordinarily tired about predictions that the strait would reopen and there would be an agreement. But there was an announcement that the Iranians had agreed to a 15-year moratorium on uranium production. And the reason that caught my attention, and we apply this standard, by the way, to, M&A rumors, other rumors like that. It's one thing to say, okay, well, Marvell is going to get bought out. But if it's like SoftBank is going to buy it out, and by the way, none of this is true. It was true like 240 points ago. That's why I picked on Marvell. But Marvell is going to be bought out for $300. Well, which is again totally not true. But if that did come out, we have specificity on the price and the buyer. So that means that it can't be if it's reported by a credible news agency, it can't be total fantasy because of the fact that they can't make up the 15 years. And it is consistent with what the president has been saying, that they're getting close to an agreement. So it would be consistent with like, oh, no, it needs to be 20, no, it needs to be 10. And then they compromise on, on this level. So it's consistent with our view, although, we haven't the specifics we've been wrong on, that the strait's going to reopen. You should stick to your positions. You don't have to be like gambling too much. Stick to your positions. We're going to get to 9,000 by the end of the year. And it's fine to be bullish. Doesn't mean that tomorrow that whole story will get denied. But it does seem like we're on track, and maybe we'll just end all this nonsense and open up the strait by force, which has been more our base case. But the real insight, that's been more wrong than right, but our real insight is just, it's not going to last forever. Don't panic and don't miss out on some of these great opportunities, not just in tech, but REITs, financials, across the board, and riskier type investments. I'm not sure you need to be in consumer staples. Yeah, we're somewhere between 82. If they're just this nonsense goes on for the rest of the year, we're at 8,200. It's not that great, by the way. In other words, if we're at 7,600 in June and our target's 8,200 at the end of the year, perfectly reasonable pullback. And then just a couple other points about the market. Keep in mind, June is normally a terrible month for the market. So I'd argue the activity today has been, to date rather, in June, been sort of normal-ish, maybe a little more bullish because it's not actually going down that much. And then we got to get to the SpaceX IPO. We never had $75 billion IPO. Can the market really absorb it? If the overall market's weak, the IPO could be weak. We don't know how many Musk acolytes there are because it's clearly an overpriced deal. So we just need to kind of get that in the rearview mirror because I think that's what's destabilizing the tech market this week.
Yeah, I completely agree with all of that. And today, I mean, so much for lazy summer days in media and on Wall Street. I mean, here we started the day, we heard about this helicopter that had an accident at the Strait of Hormuz. Then it turns out it was shot down by Iranians. Our soldiers are fine, they're safe. But now you have, like you said, a possible 15-year moratorium on uranium production, which then I suppose the president, if it is true, the president could say it's a victory. However, he has been saying, I will never let the Iranians produce a nuclear weapon. So then the Democrats will pounce on that. So we'll have to see how all this plays out. But with that, you mentioned it, chips, technology, the volatility is extreme. How are you positioning QVol? Because it just so happens that you have a ticker symbol with VOL in it.
Well, we have been right. We had held off writing calls because we thought that there's this digital outcome on the war. Having said that, actually the biggest dynamic in the morning was that oil was down and there was optimism about the war ending. Well, that's not actually that good for tech. Tech was like, at least after the first few minutes, rolling over. It was actually better for financials and some of the other sectors. But notwithstanding that, we're more long-term focused. So we are still focused on reasonably priced growth companies. And so, but just in terms of new developments, we have significantly reduced our overweight in Marvell because that's just a unique situation where Jensen Huang kind of got it to go up 100 points. And so not that it's a bad investment, but it's just clearly riskier. When we recommended it on CNBC a month and a half ago at 90, so you should always take profits when you're up 250%. So we have been taking profits and huge gainers, a little bit of cash now, given the SpaceX 5% cash, given the SpaceX IPO. And like I said, it'd be great if the war ends, but it's better for financials than it is for tech. So you don't have to necessarily position to be super long. But
Hmm.
we've been outperforming Q Vol, and we just think that avoiding the dogs of the DAC, like you don't need to be like probably most people haven't mentioned this before. You're in Warner Brothers, so you're doing merger arbitrage.
Right.
Okay, maybe you want to do that. Well, just do that separately or do a merger arbitrage fund, but you don't need it in your QQQs. You want
Yeah.
to bet on growth, and in our case, at a reasonable price. That's going to be a long-term objective. And in the short term, we wrote some Apple calls today because that clear disappointment there. Very expensive stock. We're underweight that quite a bit already. And we wrote some Broadcom calls because we actually love the stock that hedge funds are pounding on it. So again, we're using curation to pick where we write on and only writing where we have gains.
So you know that Marvell is being included in the S&P 500. How much of a potential premium to its stock price would you anticipate with that inclusion?
Well, that's why we sold it yesterday, is usually it pops up and then it comes back down. And then what happens is all the, not hedge funds, but all the Wall Street, so all the big investment banks, they position for that. So the big gain, and so we did trade that well. The big gain is when it gets announced, not actually when it gets added. There might be a tiny bit when it gets added, but unless the street's mispositioned, we see this, it's kind of a dumb example, but in preferred stocks, like the street figures out the adds and subtracts and they get ready for it. And so they reduce the volatility when it actually gets added at the end of the month. Same thing should happen for Marvell. So that should have been priced in. A little bit of a panic selling after that, but we did trim it yesterday at the highs. So that's what you should normally do. You trade the event, so it goes up 10% when it gets out, and then you sell some and see if it comes back in, which it did today, but not for that reason. This came in because I think the SpaceX IPO really.
Yeah, and let's talk about the SpaceX IPO. So, do you believe that this is the biggest IPO since Alibaba?
Well, I mean, in size it is, and what's a little bit disconcerting about that is means the lockup will be the biggest ever, 1.75 trillion. I do think I understand why they did it because I used to be an investment banker. The way you win, it's called a bake-off. The way you win is by assuming some gigantic price. So it's kind of your job to go jam this on everybody. Having said that, I look at Tesla, and in our models, it's 300% overvalued.
Wow.
It's worth 100 and it's at 400. It's kind of the bad bank of the Musk empire, good bank being SpaceX. So like that can be at 300% premium. We're estimating SpaceX at a 50. It could trade up a lot. A broker just asked if I wanted to participate in it. It's not a good sign because I don't pay a lot of commissions to Wall Street. So, but I wouldn't over extrapolate that. But it's going to be crapshoot. If the market's strong, it'll probably go up. If the market's weak, stock, tech market that is, it might trade down. But we just don't know. This has never been done before. There's a lot of retail allocation. Sometimes when you allocate retail, like certain firms have these huge penalties for dumping it. So if it's done correctly, it should trade higher because there's all these Musk followers. And if you don't believe they are, just look at how ridiculous um, Tesla's stock prices. That is a horrible, horrible company. They've got a terrible electric vehicle business. They're trailing in robo-taxis, which isn't even a good business anyway. And they've got some vaporware on the robotic side. So just like the estimates go down every day, trades at 220 times earnings. So if that's true, like that's just reality. Like you can get unhappy about it. I wouldn't short it. But if that's true, then just SpaceX is a great company. So only imagine what that could go to. So none of us know. We'll see what happens. It's a lot of it's if the war gets resolved, again, not that that's so great for tech, but if the war gets resolved, then it's almost certainly going to trade up.
Do you believe investment banks may be leaving money on the table, though, by allowing such a small public float on the SpaceX deal?
If they had priced it at a trillion, yes, but they're taking the free money out of it.
Okay. All
I
right.
mean, we used to do this. I would actually, and it was appropriate because these companies weren't good long-term companies, but I used to do power tech, and everybody said, "Oh, well, this company went public. They were at 300 million, but now they're at 3 billion. So we want to go public at 3 billion." And I said, "No, no, 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 no. We're going to go public at 300 million. If it trades 3 billion, then that's accrues to the people who went into the deal." So they've kind of taken that out, at least part of it out of the deal, the big pop. So, but maybe it'll pop more just because of the Musk halo. And there's a bunch of people, just look online, promoting the heck out of this IPO.
Yeah, yeah. So, but with such a small public float, are you anticipating it to be, I mean, it could be seriously volatile, correct?
Well, I wouldn't call 75 billion. I mean, it's small as a percentage, but not small in absolute. This
Okay.
is why, like, the real answer, which nobody really wants, but we've talked about it before. Like we talked about it with Warsh. Like, I don't know how he's going to get nominated, but he's going to get nominated. So, so it's okay to not know. Although it sounds kind of dumb, but
Right.
I don't think we know. Like, maybe Goldman knows because they can see the book and where they're putting the stock and how confident they are that they've locked it up. And also, we don't know what the market's like. I mean, if it's down 35 handles, okay, then it's probably going to trade up. But if that day, everybody's selling to get into the deal, and it was like it was earlier before this war rumor came out, like it's not going to probably trade up that much. If like the Nasdaq's down 700 points, which it was earlier. So it's an unknowable thing. I would say if you're looking at going into it, it's like a fair bet. It might go down 20, it might go up 60 or 40. Maybe the probabilities are about that. I don't know. But until
Right.
we know these things, like what is the market going to do over the next 3 days? Is it just going to sell off hard into the IPO? Well, then that's not going to be good.
Yeah, yeah. I want to go back to your Tesla story before we'll turn the page to the Fed in a moment. But why are you so bearish? I mean, is it just the valuation alone, or is there something about the idea of having electric cars?
We think that it's like three or four things. We believe that and have for like literally 35 years that the technology path is hybrids. And I did power technology literally 35 years ago, Ballard Power. And I figured out early on, because back then they already had hybrids. Well, that's what makes sense because you start out with a hybrid engine, it's small. And then over time, when the battery technology gets better, you shrink down the amount of gasoline, you keep shrinking it down. Maybe you never go to zero because you always want the safety of backlog. Like, go try to rent. I've been in Vegas where they're trying to rent Teslas, They
Hmm.
couldn't give them away because people don't want to die in the desert because they have no electricity. So just a bad, they picked the wrong technology, tons of competition from the Chinese. Hybrids are booming, but the estimates are coming down every month for the overall company. So not a good core business, massively overvalued. Ford and GM traded like 6 times earnings, trading at 220 times earnings. And then total vaporware on robotics, vaporware so far on self-driving and robo-taxis. And more importantly, this is the bad bank. That's why Musk promised to buy it. He put all the great businesses in SpaceX. Look at his AI. It has, it has Starlink, the space part of the business. Those are all great. It has the AI infrastructure business, the data center business. So that's the good bank, and Tesla's the bad bank. Now he's going to bail it out, which you might argue is fraudulent because it really is worth 100, not 400. And he's everything he said would happen has not happened. The
Mm.
cheap car. Now they're not even going to make all the other models. Everything was just a complete vaporware. But nobody seems to care. It still stays at 400. And that's why the really thing is not to get mad about it, but just learn from it. Like, okay, SpaceX could go to 4 trillion. Who knows if that's overvalued by 300%. But it's never happened before. So anybody who claims for sure, oh, it's going to trade way higher, it
Hmm.
may, but their certainty is unwarranted. The next
Okay.
biggest IPO was that's an oil company, which has nothing to do with this whatsoever, was at 25 billion.
20. Okay. 25. But which one was that?
That was Saudi Arabia's Aramco.
Oh, okay. There you go. Okay.
So 3 times as big. So if you think for certain just go like I used to do this. And just imagine yourself in the room in Goldman Sachs allocating $75 billion of stock and trying to guarantee that nobody's going to flip it.
Yeah.
They
Yeah.
they might they're you don't have a good chance of doing that because everybody loves Musk, but Ron Barron, there's all these, the ARK funds. They're not going to flip it, but I don't know about everybody else. So God bless them. That's a hard job. They have a good chance of making it work, but just recognize this is not the normal scam of an IPO is what you were talking about. You're like, okay, it has $1 billion valuation, or $10 billion valuation, and we're going to offer 300 million of stock.
Hmm.
So first of all, it's like whatever 3% of the float, and it's just not a lot of stock. Like Fidelity can take down 300 million stock.
Yeah.
So it's not like those IPOs where it really is. It's not just a small percentage; it's a small amount. And
Hmm.
look,
Hmm.
like I said, I'd say it's maybe 60% chance it trades up, 40 down, but it does matter what's going on in the market as a whole.
Right. And if I'm working at Goldman Sachs on this deal, you're my first call, Jay Hatfield. I just want to say that. So
Well, you have to
that,
pay a lot of commissions to get allocations too, so we don't do that. We don't. We want to outperform and want to do good service to our clients, so we try to pay as little commission. And of course, we own our own funds, pay as small commissions as you possibly
yeah.
can. And
Yeah.
I'm not sure it's legal, but if you don't pay commissions, you don't get IPO stuff.
Yeah, well, I don't know either, but yeah, you guys are sensational for your clients. There's no doubt about that. Let's turn quickly to next week's Fed meeting and give everyone a preview. It's Kevin Warsh's first Fed meeting. I assume that he must have completed new employee orientation last week, so now he's getting ready for next week. Are you anticipating any big surprises?
No, but this is really core to understanding economics. So there's a huge battle, and obviously, it has a political element to it. I'm more of a moderate between the Keynesians. So Keynesians are liberals who believe all economic growth comes from the demand side, and the government spending is fantastic, great way to juice growth, and that money doesn't matter, and that expectations do.
Yeah.
We And I was trained, thankfully, before every university in the country became a liberal propaganda machine, before by a monitor, strict monitress. So
Mm.
we believe that inflation comes from excessive money supply growth, M0. Expectations, this comes from me, but are actually inflationary expectations reduce inflation because it shows up in the bond market, bond prices rise, economy slows, particularly interest rate economy. And so the Keynesians are just holding on to that stupid expectations theory because they have no other way of explaining inflation. So there's going to be a pretty big battle between the three Republicans who are mostly supply side monetarists and the nine Keynesians. But the Fed chair does have a lot of power. Like nobody's going to want to have the first decision overruled with the Fed chair dissenting. That's would be kind of ridiculous. So we believe he will prevail. It's absolutely incompetent and even stupid to raise rates because inflation's higher because of oil prices. As oil prices are a global commodity, the Fed is already tight, notwithstanding Keynesian nonsense that it isn't. The interest rate sensitive portion of the economy is in recession. That's absolutely true, data on our website. And so it would be purely insane to raise rates. So they're going to hold neutral. That's kind of 95%. The notion they're going to raise rates at all, ridiculous, even if the strait doesn't reopen. If it does, we're sticking to 3 cuts in the next year because the data does need to show up. Like, we don't think Warsh is just going to be like, oh, inflation's at 3 and we're going to jam it. But he's going to correct the indices either using trim mean or some of the corrections we do. It is already contained without oil. So I wouldn't worry about there's going to be plenty of bearish commentary, but hopefully Warsh will contain some of that. I don't think, well, it's not a dot plot month. No, actually, it is a dot plot month. So maybe they'll get rid of the dot plot because that freaks everybody out. And
Yeah, and I want to follow up with that because Kevin Warsh has been very upfront about trying to pull back the amount of transparency coming out of the Fed, and even with Fed speak, he's trying to limit the amount of
yeah,
speeches
because
and.
what we don't need, well, there'll probably be a few dissents for people who want to raise rates. So it's going to get out there anyway.
Hmm.
So I guess that's a mild negative, but it's worse is going to come out strongly. I guess he's going to do a press conference. And so, or he'll just talk to the press. So he should be able to tamp down and give confidence that he's going to overrule these Keynesian hawks. Because again, they're worried that okay, oil prices are higher, so inflation is going to go higher because everybody's expecting it to go higher, even though that was just a bogus theory that came from the 70s when people didn't understand oil prices bled into core. And the Keynesians are clinging to because they can't explain monetary inflations. But if you think I'm being political, go look at the real data. Keynesianism does not fit any empirical data. The Fed has
Yeah.
caused every recession. Growth is not inflationary unless it's caused by excessive monetary growth. So, in other words, late 90s, you remember that Y2K, the Fed was expanding the money supply. That growth was overheated because it came from the monetary sector. Obviously, the growth in 21 completely coming from the monetary sector. So economic growth doesn't cause inflation unless there's excessive monetary growth. Keynesians don't understand this. They use this expectations theory. So even though that was a long harangue, that's the inside baseball of what's going to be happening in that room. And we believe Warsh will prevail and tamp down. There'll probably be a few dissents, but tamp down this complete nonsense coming out of Keynesianism. And we do believe it's politically motivated. If you were a true economist, you would revise your models because they blew up during the pandemic.
Hmm. Hmm. Now, with the drop in communication, though, do you think that we're going to revert back to maybe the Greenspan briefcase indicator?
Well, I don't think we'll go far quite that far. I think Warsh hasn't really mastered saying nothing while talking a lot, which was like the Greenspan probably was the all time expert at that.
Yeah.
So I don't think he's just going to put out gobbledygook. So I think he'll continue to put out more supply side and less of a monetarist, but monetarist type commentary that will be bullish. And these other governors are not going to be completely silenced. So Kashkaris will come up with their nonsense. But the good news is there's going to be a stalemate while the straits closed. And then after the straits closed, we strongly believe and forecast inflation is going to come down like a rock, and then everybody will want to cut. So that's our bull case. We had correctly indicated that there was no chance that Fed was going to cut because the labor market got weak. So we were not surprised by the strong data that came out, although it's not reliable, but strong data that came out last Friday. That was not our thesis. Our thesis is that oil goes back to below 70. We're more bullish about that than almost anyone, but I'm highly confident of that. It's already trading way down and we haven't even opened straight. And when oil comes down, then you'll start to see tariffs rolling off. You'll start to see shelter coming back to what we already know is true. Warsh is going to do some corrections, like use like some of the ones like we do, or maybe more tactical ones like trim mean. So we're strongly believe that the Fed funds market's 100% wrong. Definitely no increases and likely 3 cuts. We're just saying over the next 12 months because we do need the data. Warsh is not going to be able to jam all these Keynesians into cutting rates because he's optimistic about inflation. He's correctly optimistic about inflation, but it's not going to be something that he can just jam onto committee.
Right, right. Jay, I want to ask you an academic question, and it's different, sort of different topic. With supply side economics, it does have an ending. Why is that? You would think that that type of policy would continue for decades. I mean, why does it end? We saw that with the Reagan administration. We're not saying we're seeing it now, but there will be an end time. Why is that?
Well, do you mean when the Democratic Socialists take over, or
Okay.
is that what you meant by that? Because
I
it,
didn't think of that.
it
Okay.
is
That answers
ongoing,
my question.
but it is ongoing. And again, what's great about economics, like you and I can argue, Trump was at the game. Oh, should we boo him, cheer him? What all these political issues. There's no answer, right?
Right.
I believe oil is going to go below 70 when the strait reopens. We will know. Okay. You can all come back and you go, oh, Jay, look, it's still at 80. You're an idiot. I think it's going to be, oh, you're right yet again. We're occasionally wrong, but normally right. But well, no, it won't be, oh, actually, I think Biden was a great president and Kamala. There's none of that nonsense. It's like it's either below 70 or it's not. But if you go look at the data, um, investment drives the entire economic cycle. Monetary policy drives investment. And this is the money data. IMF, which is not a conservative bastion, I would argue they're liberal, has
Hmm.
fantastic data. Economic growth is 80% correlated with savings and investment. Saving and investment have to equal. That's just the economic law. And they even have a number. Every 10% of savings of GDP equals 1.5% growth. So China, you might wonder, well, they're communists. Why do they grow so fast? Well, they save 50 or 45. So 1.5 times 4.5, they average like 5.5%, 6% growth. And that's kind of obvious. Like if you save 20% of your paycheck, guess what? In 10 years, you're going to be, a lot of it come from investment income, but you're going to double your income. This is
Yeah.
exactly what corporations do, and it's what countries do. It's obvious, and that the data though is overwhelming. This whole demand side stuff is complete nonsense. Investment drives employment. Employment drives consumption. So you need investment, and that's why also last comment. And this whole notion that AI is going to blow up the job market is ridiculous. Get higher returns on investment, more profits, more growth, more jobs. Not the same jobs. Like my son's looking, he's an engineer, and defense companies, they're not reducing all their labor force because of AI. So it's,
Yep.
it might be different mix. Maybe you don't want to be a software engineer, maybe you want to be an electrician, but the job market clears, wages move up and down between sectors. And what's really great is that AI boom is not really displacing low income wages. And that would be a problem because you have a $15 minimum wage and you eliminate all low skilled labor, then it won't clear. Like nobody could get a job. But that's not happening. It's higher wage workers. So this whole Keynesian thing, it's out there. That's what everybody was taught. That's what everybody on TV says. But it happens to be 100% wrong.
Hmm.
And I actually kind of hope that everybody continues to be an idiot because it gives you a huge advantage. Where they're forecasting Fed funds rising and it's really going to go down, creates an opportunity, and interest rates not right this moment in time, but when Strait reopens, the financials they're working today, financials, REITs, because there's just excessive bearishness because of all this Keynesian propaganda, in my opinion.
I love it. I think we should change the name to Hatfield Unfiltered. That would be
Well, I can be a little bit more, we'll have more time. When you go on national television, you have to keep it pretty truncated and you have to
Oh
be a
yeah.
little bit more in the, you never know who the president has watched some of the things I've said.
Of course.
Yeah,
Of
so
course he
you
has.
don't want to just like go, you can be a little bit more open when you're in a slightly more narrow broadcasting version.
Well, I'll reach back out to the administration, see if we can get the president or even Treasury Secretary Besson on the show with us. So we'll
That
see
would
what
be
we can
good.
do.
Or just get a Keynesian. It would be good to have a debate.
That would be a great debate,
Yeah.
actually. Great television. All right, Jay, we're going to leave it there. I know you're busy. I see the Dow has turned positive, so we're maybe moving on back higher for the rest of the day. We'll see what
Yeah.
happens as we play out the remainder of the trading day. But I do appreciate you joining me. I can't wait to see you again next week, next Tuesday.
Thanks, Todd. Great to be on.
Thank you, Jay. So on behalf of Jay Hatfield, I am Todd Schoenberger. Thank you once again for joining us on Hatfield Economics. We'll catch you next time. Take care.
There's more happening behind the headlines, and you deserve the full story. At Biz Talk Today TV, we break down investing, government moves, entertainment business, and even sports gambling, all in one place. Real conversations, smart insights, content that helps you think smarter and stay ahead. Thousands are tuning in. Don't miss what's next. Subscribe now to Biz Talk Today TV on YouTube and join the conversation shaping the future.